Joining Victor, Adam Aders from a farm in South Australia, managing Anterra Capital. We've got Anuj Maheshwai, who's the Managing Director of Agribusiness at Singapore-based VC Temasek. We've got Matthew Pryor, the co-founder and Managing Director of Tenacious Ventures. And Adam, Anuj and Matthew, of course, being joined by Victor and the sensational, the one, the only, Ethy Levy, who's going to lead this conversation. Would you please welcome this fireside chat?
So first of all, I'm very happy to be here at evokeAG for the first time. It's been a while since the second one. We had the pandemic in the middle. And what a great international panel today. So we are covering almost all the continents with Victor representing America, Anuj, Asia, Adam, Europe, although born and raised in Adelaide, Matthew, Australia, and myself from Israel, which is in between continents because we play basketball in the Europe League, but soccer in the Asia League, so we're in between. But what we all have in common is a passion for technology and for disruption, but also a passion for agriculture, food, and sustainability. So, dear and estimated panel members, I will start with a quick round of insights. And if you could share with us two of the most exciting trends that you are foreseeing for the next 3 to 5 years. And if you don't mind, Anuj, we'll start with you.
Thank you, Ethy. For me, the two trends that stand out are decarbonization of agriculture, and the second one would be climate resilience and adaptation. And decarbonization is obviously something which is going to be long-term. I see the decarbonization of the cow, I see decarbonization of rice, of fertilizers, and we are obviously backing companies like Pivot Bio, like others who are decarbonizing parts of it. And I see the whole alternate protein or sustainable proteins sort of fitting into that trend. I think the part that we have doubled down as an institution last year and made some large investments has been in climate adaptation and resilience, whether it is water scarcity or too much water at times, which you in Australia here are well aware of. We've invested in drip irrigation companies in Israel. We have also invested in companies that are producing agriculture through greenhouses, through vertical farms, and recently backed a company in Australia called Perfection Fresh, which is the largest distributor of tomatoes, peppers, cucumbers in Australia. So I see these as the two trends, decarbonization and climate resilience, at least for us going into the coming year. But obviously there's so much to do in the food and agriculture value chain.
Thank you, Anuj.
Sure,
Adam.
thank you. I'll take a slightly different angle. So two, what we think are very exciting investment themes, which will also have a positive impact on the elements that Anuj mentioned. One would be, we see an enormous opportunity to take the more mature and better funded human health biotech arena and see how we can apply that technology and that exorbitant, or not exorbitant, that large number of dollars compared to our venture capital community, and apply that to plant science and animal science. It's a fast-moving sector. It's a very mature venture capital sector, and we see early results. We're very excited about that. And the second one for me would be, look, it's a similar idea. FinTech has transformed our financial services sector and many other broader categories, and we see enormous opportunities to help the food and agriculture value chain by having a more sophisticated, a faster, and more efficient adoption of not just loans, payments, but insurances, hedging products, risk products, and a more efficient value chain. And I think that's going to help everyone, hopefully especially farmers.
So you're balancing between biotech, which is long-term high risk, and fintech, which is faster and a little bit lower risk.
Look, I wish more of the stuff we did was low risk. That's not the domain for venture capital, unfortunately, but we do our best.
Thanks, Adam. Victor, you mentioned a number of the trends that you're focusing on, but I'll be happy to hear.
Well, I think because I just spent time there, I'm going to take a moment of privilege here and just say how exciting it is for me to be on the panel with this group. First of all, like just looking back, when I got started in 2013, there were not a lot of people doing what we're doing, and Anuj and Adam were kind of a very small group of people who understood where this was all going, and it helped bring a kind of a camaraderie.
Yeah, we couldn't fill a small room, let alone a convention centre.
No, exactly, and look where we've come.
Yeah, no, I agree. That's wonderful, and for me to be back in Adelaide. So I should have mentioned that first up. Wonderful to be back in Adelaide, and to see a great crew come together of Australians supporting AgTech.
Yeah, so I just wanted to sort of say that. I think just briefly on sort of two areas that I'm really interested in above and beyond the food health nexus and kind of the things that I talked about. Supply chain integrity, that doesn't sound like a super sexy thing, but from the perspective that the consumer, and when I use the word consumer, I'm just talking about ourselves, right? We tend to talk about consumers as they're this other thing. It's us. And it's basically us creating the things that we demand. And that is becoming more and more about, healthy and traceable and efficacious, all these sort of things that the consumer now wants on top of being, affordable and accessible. But being able to deliver that every day and to do that that's verifiable and is integrity, driven, that's really hard to do. And there are companies that are starting to do that hard work. They're kind of in that unsexy middle, but that unsexy middle is really the difference between seeing the products that we're ultimately going to want to be able to nourish ourselves and our families and not. So.
Yeah, I think this is a very important point, and as consumers, it gives us much more influence on the big companies and on the food production. I met this very interesting startup from India that is doing traceability with blockchain, but many are doing that. But the interesting part is that as a consumer, when you buy the product, you actually know how much of your dollar is going to the grower, which I think that as a consumer, for me, it's something that is important. Just, in addition to the quality and the provenance, I would like to know that it's fair for the grower as well. So really interesting. Matthew.
Yeah, thank you. Hey, everyone. So awesome to be here. And I'll take a cue.
I think we need some energy. So
I'll take a cue from Victor, which is, the kind of OG AgTech. I actually was chasing these guys around the corridors at the World Agritech Expo. Seems like an eternity ago, and it's so awesome to be in a room like this in Australia now, where we used to have to get on planes to find rooms like this to get investment into Australian companies. I think we talked a bit about a lot of change that's being made here, and a lot of this change, we're actually asking farmers to do things different ways. And I think a really important part there is where are those incentives going to come from? And Adam, you touched on, there is an enormous set of possibilities around risk and finance, and we have an entire kind of pathway. We talk about embedded risk and finance, and there's satellites observing everything and models modeling everything, and the ability to help farmers very significantly. Our risk managers are very good risk managers, but there's going to be this whole new suite of tools there, and we've got some fantastic investments in this area. I am going to name check a couple of portfolio companies, I'm sorry, but companies like Geora, companies like Cecil, companies like Regrow, who are really adding into this picture of we can't just ask people to do things differently. We've got to say, and what, right? And what will you get? What will we'll be able to give you? How will we make things better, make things different? And I think another big challenge is, another thing we're asking farmers to do differently is use less, fewer inputs. And so if this lower intensity production is going to work, we have to have things that will deliver there. Maybe it's Jupiter Ionics, who, like Arthur C. Clarke says, what any sufficiently advanced technology is indistinguishable from magic, like that you can create ammonia directly from sunlight, air, and water. That's the kind of promise, amazing potential. But if we're going to use less nitrogen, fewer inputs, Swarm Farm, who are autonomously managing 1.4 million hectares of low chemical intensity production, that these are really exciting transformational changes that also have to happen on farm if we want all these benefits to flow along the supply chain.
And Matthew, maybe I'll continue with you. Since your fund is investing mostly in Australia and New Zealand, Do you think that there are special strengths in the Australian ecosystem, in the startups here, that international investors should pay attention to?
Yeah, people
Briefly.
will yawn when I say this, but I mean, you know, if Australia was going to pick one thing to claim to be world class at, you know, we would have to pick innovative, climate adaptive agriculture. We didn't necessarily call it that, you know, when all of the original IDC system was put together, but it'd be that and swimming would be, you know, two things that we would easily be known for on a global stage and would deserve a podium finish.
Okay, thank you. So since you mentioned climate and sustainability, we mentioned we're passionate about it. I'd like to hear from you, you know, your approach to the issue of sustainability in agribusiness. And what step as fund manager do you take to ensure that your investments align with sustainable practice and goals? And it's a big question, I know, but if we can narrow it down to practical steps that you're taking, who wants to?
I can. So, if you invest in the future of agriculture and food, you are automatically aligned to sustainability. Now, that's a very broad statement I'm making over here. So, because this is a sector which has so many aspects to planetary sustainability, to social impact, that usually companies that we are looking to invest in, at least this group over here, are a force for the good. As Temasek, we are not going and looking for ESG KPIs. We are looking for companies that are making the world better. Now, we also are willing to invest in companies which are in today and are part of the problem, because we want to invest in them and bring them to a transition where they are part of the solution. So that's how at least we as a firm look at it, is invest in new technologies which are part of the solution, and invest in some of the old companies but help them make a transition towards a net zero world.
I couldn't agree with Anuj more on that. And so for New Epoch Capital, I started to think about how to look at ESG in a different way. And frankly, I was pretty overwhelmed and underwhelmed at the same time by ESG, and trying to operationalize that has a lot of complexity, and especially for smaller funds, you know, very difficult. And for startup, you know, CEOs and C-suites who are just trying to get through the day, you know, to get to the next, you know, customer in the next funding round, it's very difficult. So I started to think the way Anuj is thinking, which is, at the end of the day, what is the mission of that company? What is its essential DNA? What is it doing? Why is it on the planet doing what it's doing? And I call that first order impact. So I created this sort of framework that says, what is its first order impact? And then all of its other aspects, you know, how it might improve sort of supply chain, or it might do diversity on its board, or it might do offsets or credits. Those are important, and you can calculate those. But as investors, are you going to invest into the company because of that? No. You're going to invest in it because what the purpose of that company is, and the mission of its CEOs and founders, is to create impact. And in every new customer that comes into that business, you should be able to not only identify the financial unit of impact, but the actual impact unit. And so I started looking at sort of businesses more that way. I call that first order impact, and that's how New Epoch Capital is going to be investing.
Yeah, I totally agree with you. I think that the DNA of the company has to be aligned with the business of the company and needs to grow, you know, in exactly the same.
Just as a quick example, like to kind of bring it home, and it's hyperbolic. So you wouldn't, as an investor, invest in a women's-led organic tobacco company, right? Like, it doesn't matter what the ESG lens on that is.
Depends what the tobacco is used for.
What's that?
It depends what is the use of the tobacco.
That's
you know,
true.
in Israel, we grow human collagen on tobacco plants. So
And in fact, in Israel, I saw an amazing technology with tobacco. I agree.
We get your point.
It's hyperbolic, but you see with the point.
Yes. Yeah. Thank you. Adam, do you want to comment on that?
Well, I agree with my two colleagues, and I think the key message to take away from that is, especially for early stage companies, don't look for multiple metrics. At Anterra, we don't.
Yeah.
We're looking for one audacious goal that will make a material difference. For us, we've identified 3 pillars around improving farmers' lives, improving the life of animals and the health of animals, and then also improving human health, but not through our present process of eat whatever you want and drug yourself later, but actually food that will enhance our health from the get-go. And but you know, for me, it's more important to go after one big goal rather than spend your time collecting a lot of metrics. And I think that's been already echoed in what's been said.
So we all agree that ESG is overrated.
No, I don't think it's overrated. I think
calculation, measurement
going
of
searching
ESG in
for
funds.
lots of metrics, expending a lot of time as a fund or as an individual company, collecting 72 metrics and then proving that no matter what you're doing, you're going to hit one of them. That is a misuse of time and resource. Yeah. But it's incredibly powerful to have a clear vision and make a difference. And that doesn't just bring, obviously, the benefit of improving our world, but it brings more loyal employees. It brings, these days, access to different capital. And it actually, in my opinion, de-risks and improves the financial return. So I think it's vitally important. I just think it's being overused as
I meant the measurement. Yes, I didn't mean the ESG. Yeah. Obviously, we're deeply into that.
I think that's
the measurement is challenging for funds and for startups, and we need to be very clear on the metrics.
But I think that's the negative reaction that people who deliver impact natively, like we do, have with ESG, because it gets put into a box where it's just measurement, and there is no necessarily value about the measurement. We have to have movement. If we don't have movement, we don't have impact. And I think that that's the thing. You know, in Australia, there's a lot of conversations going on at the moment about ESG. If you want to deliver impact, invest in agriculture. Like it's, you know, there just is nowhere nearly enough money coming into agriculture.
Don't just invest in agriculture, invest in agricultural tech. The level
innovation
of technology
innovation
is
in agriculture
exponential compared to providing a few loans. If we can leverage technology, we're going to make a difference, in my opinion, whereas just a better cold storage system or a few more farms, a few more acres farmed, we're doing a pretty good job of nearly every available acre in Australia, but not in Africa. That's just a marginal difference as opposed to leveraging some of the technologies that are here or at similar events and in some of the portfolios of the
And you know what? You can have returns as well. So, you know.
I think we all agree on that. Thank you. So we'll talk a bit about the VC world. Here we are all managing VC funds, some very large, some extremely large, some smaller, and some very small, but very specialized and no less attractive. But my question to you is, you know, now that we have ChatGPT and AI and you know, private investors, they have access to lots of knowledge and lots of information, can do a pretty good due diligence on companies. Are we still relevant?
Well, I'll have one.
Israeli and shocking.
ChatGPT cannot remove technical risk. It might be able to analyze it, but it can't remove it. And like if there was anything that venture capital was for, it's for removal of technical risk. And you can't analyze your way out of technical risk. You can only remove it.
I think I would sort of answer it this way. At the end of the day, let's demystify venture capital and sort of private equity. At the end of the day, it is a data, trust, and relationship business. And I think we've learned from ChatGPT over the last couple of weeks, trust is not really its thing. So I'm not sure as those technologies develop, you know, that's gonna, you know, really put us out of work. Just a sort of an example, I was kind of thinking about this because I was trying to, like, on the Beyond Meat investment, how did that really happen? And on the Beyond Meat investment, ultimately, it was data and it was relationships. Danielle Gould, I don't know if people know her, but she founded this thing called Food Tech Connect. Before anybody was really looking at food tech and sort of ecosystems, she was doing that early work in 2009, 2010. And she was creating a database of like deals that were happening in food, and there was no other place to go to find that. And when I was starting S2G, that was the only place I could go to find out what was happening. And there was this, I remember seeing it, this thing called Beyond Meat. Okay, so I started tracking that. When I was setting up the company in Chicago, there was a guy in Chicago I had known for decades, Dan Line, who had a friend, Nate Laurel. Nate Laurel was my landlord at S2G. He had just founded a fund with Ray Lane, who was one of the original investors in Beyond Meat. I knew that I was interested in Beyond Meat, so when I went to Ray Lane, I could start making a case for why S2G should be an investor on. This was all relationships. This was all kind of collaborative effort. So one message to the group here is like the conversations that you have and the relationships that you form are going to come into play at some point in which you're going to be at the right time and the right place. And so when you meet people, always keep that in mind, because ultimately for S2G and for Beyond Meat, it was those relationships mixed with data.
I'm going to answer the question a little differently. We don't yet have nutritious, sustainable, and affordable food. So my answer to your question is we've still got a big job to do, and venture capital will play a role. Now, if ChatGPT or anything else is going to accelerate that, well and good. I'm lucky enough to have my mum and my daughter here today. If they can jump on ChatGPT and they can solve this instead of us having to deploy millions of dollars and take many years, great. But that's not the case yet, so I think I've still got a job.
Excellent. I was asking this question also in relation to the recent TechCrunch report that was saying that less than 5% of the fund are successful, but obviously we have the 5% here on stage, so we're good. My next question. Victor, you mentioned in your presentation blended capital. I'm not sure everyone is familiar with the term, so if you could really briefly give us a quick intro into blended capital and why you think that this is one of the way we will be able to fund more agri and food projects.
Yeah, and it's really kind of a testament to FoodShot Global sort of vision and sort of the way that team thinks about it, and was the reason why it got founded, was that, and I think that's the case here probably in Australia as well, there's a lot of technology and science that's sitting in universities or in labs or in other places that are looking for a route to market. But before venture capital can sort of come in, generally, I mean, Anterra's, one of the ones that actually takes a little more early technology and science risk, kind of in this sector and the like. But there are very few who do that. So you need dollars to come in earlier that can really target some of the milestones that venture capital is looking for in order to be able to feel comfortable to go forward with that. So what FoodShot Global does is it provides that non-dilutive grant money to help move that into a position for venture capital to come. And then venture capital can say, oh, they've accomplished this milestone, and now we're ready to do, a Series A or, equity investment. You can put those together as a single instrument so that you can have both the grant money and the pledge of the venture money coming in at the same time. Mm-hmm. And so it's a very smooth kind of handoff, and we think can be catalytic from a FoodShot Global perspective.
I'll just add to, I think, a great point that Victor made, and I think what you alluded to. So I think there are many different sources of capital. To make sure that technology is adopted in the agri-food sector successfully, it has to be a very inclusive and a partnership-led approach. When it comes to early stage financing, I don't want to repeat what Victor said, bringing impact funds, bringing non-dilutive funding from the likes of research institutes, others, the Gates Foundation, so on and so forth, is very important. As Temasek, while we invest in agri-food sector, and we've invested several $1 billion in this sector, our foundation gives non-dilutive grants, and we've given almost $100 million of non-dilutive grants where we don't get a single piece of equity. We just want that idea to proliferate and that research to be done. Of course, it allows us to invest at a later point in time if we choose to, but we will compete with other sources of capital. But I think that's just at the early stage. I think what's very important for startups who come out and graduate and become more bigger companies is a partnership approach where they need to work with developmental capital. They need to work with big agri-food corporations who are not just going to be consumers, but whose venture funds are very active in this space, and really to tap into different kinds of financing to have that runway for growth. Because one thing in agriculture and food is that it takes a long time to bring technologies both to the market, or if you're not a direct-to-consumer company, then actually bring it into the supply chain. And there is obviously a lot of resistance to change. So the retailers need to be part of this conversation. The supply chain traders need to be part of the conversations. Of course, farmers and so on and so forth. So the whole approach has to be an extremely partnership-led approach from the get-go. Otherwise, many companies are not going to be successful in their core mission that we talked about.
And that's a very good entry point into the next question, which relates to exits. And I think that our sector is lacking a bit, big exits that, will bring some positive, will bring some optimism into our sector. So what do you think are the main reasons that we don't see as many exits as in other sectors? And what can we do to change that? Who wants to have a go? Adam.
Sure. I mean, a convenient answer, which is also true, is that we're just at the stage right now where venture capital activity across food and agriculture is the first generation of larger chunks of capital is just maturing. So we're just getting our first investment rounds of 100 million plus. We're at the early stage of those mature companies actually making mature ventures, making a difference to our food and agriculture system and therefore being ready for impact, able to be more objectively valued by traditional companies. So I think that's great news, and that means you will see an increase in the number of exits. I think on the negative side, as a percentage of revenue, our sector have not been deep tech investors. We don't have a whole infrastructure or examples of food companies and agriculture companies that have won through innovation, won through bold steps. And I think we're going to have to see a few of these more mature companies either get shocked and lose their market or massively win from being disruptive and leveraging the technology or if need be, acquiring the technology of some of these startups before the lights will properly be on. Mm-hmm. So we're not yet there. We can't just rely on the fact that the capital hasn't matured. There is a bit of a headwind, but the longer it takes, and it's taken a long time, the larger the price.
Do you think it's also related to the fact that most of the acquisition are from traditional agricultural companies and not necessarily tech companies? Maybe we need to...
We've got to create the companies that are attractive to both and also worthy of independent IPO. Perhaps you didn't direct that at me, sorry.
Sorry, I'll just add to that. So I think look, the IPO markets, the public markets in the last 18 months have been very difficult. I think we had many companies who were on the anvil of listings and very, what could have been fairly high quality listing. But as the environment has changed, some of the companies who are leaders in this space, which have crossed $500 million of revenues, some of them we've been part of investors in. Farmers Business Network is one example. They were ready to go for IPO, but the market changed. Now, one thing you have to remember is that the exits in this sector will come from, obviously, the traditional players who will like to buy these companies. Some of them have very healthy balance sheets. They're actively looking at acquisitions. BioFarrow was recently bought by FMC. I think Corteva is in the market, Bayer is in the market. The Cargills, the ADMs are actively investing in this sector. So everybody is looking. Yes, we haven't had a $1 billion, Climate Corp exit in the last several years since it happened. But on the other side, some of the companies which have gone scale will list. They will, as they list, have the currency to acquire more companies in the sector because that's what it is. I mean, we have to remember that the tech sector that we talk about, Google only listed in 2001, and it's been a prolific acquirer of companies. Facebook listed in 2011 or 12. It's been a prolific acquirer of companies. So the whole tech sector has developed by the companies that were once startups becoming the biggest acquirers of technology going forward. I think we are at the stage where the Google and the Facebook and the Microsoft of AgTech has not yet sort of been there, but hopefully in the next few years we will have that. And I think a lot of the early stage investments, will back on that. We are also investors, at least as part of Temasek. We don't just invest in AgTech and early stage. Early stage for us is Series B onwards, so a little bit later stage than what Adam and Victor would and Matthew would look at. But also we're looking at, we are investors in big mature companies, whether it's Olam, whether it's Bayer, whether it is animal vaccine companies and animal health companies. All of these companies are looking for technology partners. They're willing to acquire them at reasonable prices. So I think it's just a matter of time that we'll get there.
You're saying it's coming.
Hopefully, yeah. You have to be patient that it will come, and I think that's the key thesis for all of us over here.
Thank you.
If I'm being sort of candid, which I'll make the decision to be here, with 2 IPO exits, which were incredibly successful, I'd have to say that I got it all wrong. And I think you also have to look at venture capital in a way in which we make assumptions. But the market is dynamic. It's changing, all of the time. But you have to go forward. So in 2014, when SDG got founded, I think the thesis was that this first wave was going to be an entirely M&A driven, sort of exit scenario. The thesis was the big food companies and big retail and big ag. They were under pressure, and these young startups were going to come to the market, and they were going to be so disruptive. It didn't matter if they were making 70 million, 50 million, or 20 million. They were going to get bought because they became ways in which these larger companies could become future-proof. None of that materialized for the most part. The large companies stayed pretty entrenched. They were pretty cash, sort of rich. They were even more so, after COVID. But there were companies that found a path because of what they were doing, what they were trying to solve, who they were, and decisions that the board and investors and the entrepreneurs were doing that positioned them well in the market. Beyond Meat timed that IPO as perfectly as you could time an IPO. 6 months later, it probably, may not have happened. Impossible Foods was pretty much behind it. One of the reasons I didn't invest in it was that in their Series A documentation, they had a rider in it that basically said that you were signing up as an investor, but the company would never be sold to a list of companies, and they were every company that you would ever want to sell it to. So IPO was the only path forward. So I think the market is dynamic. You can go in with assumptions about when exits will happen or if they'll happen, and then you just have to make decisions about how you're going to build these companies and get them to scale.
Okay. So we can't talk about investment, especially in agtech and food, without relating to the past couple of years, where we saw a global pandemic, ongoing war between Russia and Ukraine, and total disruptions of the supply chains, and now also some instability in the capital markets. So we'll try and do it briefly because we've got 5 minutes left, but I'm really curious to know how all of this has affected your investment policies. For example, did it change the ratio of early stage versus late stage companies? Or did you look at new sectors such as supply chain and food security you mentioned? Or did you allocate more funding to support portfolio companies rather than new investment? So maybe we'll start with Matthew, and then we'll do a quick run so we can...
one thing I think we've forgotten is how much easier it made investing in companies who weren't geographically nearby, right? Pre-pandemic, it was... there was a very much a geographic tight binding. So I think that's a fantastic. We are remote native. Like we've never had an office, we've never had any kind of conventional configuration in that way. So I think that that's really freeing. There have been lots of tailwinds to a large extent. Victor, you touched on decentralization. I mean, I think it's an enormous trend. It's an inexorable reconfiguration of supply chains and manufacturing and farm inputs in particular. Everybody's concerns around, availability of food and all that sort of thing. So I think largely it's been a positive from our perspective here, with very much an Australian focus. We're kind of pre-seed and seed anyway, and so the rest of those impacts haven't really been as much of a deal for us.
Thank you, Matthew. Anyone else wants?
Sure. I mean, we thought when COVID hit that was going to be the equivalent of the global financial crisis for clean tech. We were very worried. It turned out to be an incredible tailwind to change. The disruption led people to realize that tech is actually going to be a way to make your process more efficient, more sustainable, more profitable, not a cost. And then, of course, the human tragedy and so many tragedies associated with the Ukraine war, it's created increased energy prices, increased commodity prices, more volatility. That provides one very small advantage in a tragedy of also giving tech entrepreneurs another angle in. But at the same time, there's been a massive decrease in the value of tech companies around the world. Yeah. And so there's a headwind in general tech markets, but we've got a positive momentum. I don't know where that crosses over and where we end up, but I'm still very happy that we're on the good side at this moment.
I'll just add that the pandemic and the last few years have significantly accelerated the digitization of the agri-food industry, whether it's at the consumer level, where everybody's buying their groceries online and getting it delivered, to at the farmer level, where farmers are doing the same thing, which is not just buying their grocery, but I guess also buying their inputs, using satellites, drones. I think we all heard about the need of automation. I think it's that digitization, whether it's to do with traceability, whether it's to do with inputs, whether it's to do with transparency, all of those things have hugely accelerated. Folks thought that we won't be buying goods online. But that's changing. In China, there's a company, Adopt a Cow, where you're buying dairy online. You're doing those. So consumers are changing, and I think it's a start of a huge change that will also be helpful in making the industry more efficient. So yes, it's been good. The pandemic from that perspective has been good. I think the second thing is it's also helped us realize that the food sector is fragile. Inflation that everybody has felt in the last year and also in the early part of the pandemic is something that we can only deal with if the food supply chain is more efficient. So I think it's put in a lot more focus on the food industry than pre-pandemic, where everybody assumed that their food is a given.
Yeah, and I agree. In Israel, we just had a data release that in 2022 we saw 48% decrease in investment in general, but the only sector that kept the same level of investment was the agri-food sector. So that's a very positive, and we're talking about total investment of $15 billion into the Israeli VC ecosystem. So I'm very positive about it. So just before we finish, and to wake us up a bit, because we're I think a bit jet-lagged, I'll copycat a concept that I actually saw Adam use brilliantly in a conference in London. I will ask you a set of very short questions, and we'll ask each one of you to answer with just one word. Okay? So if you were a private investor, accredited and with unlimited funding, it's a very theoretical question, and you were looking at agri-food opportunities, would you invest in early stage, late stage, or in funds? We'll do a very quick run.
Early stage. Well, that's 2 words, but sorry.
Yeah, as a private investor, early stage.
Okay.
6 words.
If I had a little bit of money, early stage, a lot of money, funds.
That was 10 words. Okay.
Late stage.
Okay, thank you. It looks like the EU is on a fast track to approve gene editing. Will you invest in that area?
Yes.
Yes.
Yes, but there are risks.
Sure. One word.
Yes.
Good. Me too. Do you think we should invest more in hardware companies in the agri-food sector?
Definitely.
Good.
No.
Yes.
Go away.
It's a very general question. Depends.
I'd say a strong yes. Next big exit in agri-food will be an acquisition, M&A, or IPO?
M&A.
IPO, but I'm tossing that to...
Very hard for them, one
I'm
word. I
tossing
know
that
those
to
people.
Anuj.
I'll be selling to Anuj.
IPO.
Are you planning on something?
Yeah.
Okay.
And
You'll tell me afterwards. The next valuation of that next big exit, below $100 million, we're talking about agri-food, yes? Below $100 million, 100 and US, not Australian, 100 to 200 or more than $200 million. Anuj, let's start with you.
more than $1 billion.
More than...
Ooh, that's good. I'm happy. Next.
Oh, I'm selling one for more than $1 billion to Anuj. I'm there.
No doubt more than $1 billion.
I think Anuj is taking us all out, apparently. So
It's more than a word, but I allow for those type of answers. How likely are you to invest in, no, alternative me to your overall invested, so no. Number one criteria for investment, each one of you, the go, no-go criteria.
Entrepreneur.
Yeah, God, it has to be team if you're only letting one.
Yeah.
Tim?
yeah, visionary founder. Yep.
Excellent. We all agree on this one. So, last question. What do you really think? Is it a good or bad time for investments?
Great time for investments.
Key vintage always is at the end of a downturn. This is it if you've got the courage.
One word.
I'm launching a fund, so yes.
I'm raising, so yes.
Yeah, era defining.
Good. So we'll just finish because there's lots of entrepreneurs in the room, and the last, insight I would like from you is what would be one piece of advice, and that can be more than one word, but not more than one sentence, that you would give to entrepreneurs in the room that are embarking on the agri-food journey. Anuj.
Choose your investors wisely and your board wisely.
Simple value proposition for your end customer. Communicate it clearly.
Resiliency.
Yeah, don't give up. Yeah.
Great. So I don't know about you, but I had a great time moderating this panel and hearing such brilliant insights and advices from these rock star investors, even without the leather jacket. So please join me in thanking them for their valuable support of our industry and for making it to Adelaide.
Well done.
Thank you. Thank you, AgriFutures.